Hi, Gigi from the RBA. This video is part of our series on monetary policy. In this video, we're going to discuss the objectives of monetary policy. But first, let's take a quick look at our roadmap. So far, we've covered an introduction to monetary policy. And in that video, we discussed what monetary policy is, and specifically, why it involves interest rates. If you haven't seen that video, I suggest you watch it before watching this one. In this video, we're going to talk about the objectives of monetary policy. The Reserve Bank's objectives guide all of the activities of the RBA, including the decisions of the Reserve Bank Board on monetary policy. The Reserve Bank has three objectives, set out in the Reserve Bank Act from 1959. These objectives are agreed between the RBA Governor and the Treasurer in the Statement of Conduct on Monetary Policy, at least once every 5 years. These objectives are central to everything we do at the RBA. We even have them displayed on the wall in the foyer of our head office. The first objective of monetary policy is the stability of the currency. Having a stable currency means that the value of money, so what you can purchase with it, doesn't change too much over time. Economists often call this the purchasing power of money. In Australia, this objective relates to how much and how quickly prices are changing in the economy. Prices are important because they determine how much of something you can purchase with a given amount of money. The change in prices over time is known as inflation. The RBA monitors how lots of different prices change, but this objective relates to the inflation in consumer prices. These are the prices of goods and services that you and I buy every day. My colleague Stefano takes you through the concept of inflation and how it's measured in some other videos. Links are in the description. The RBA interprets the stability of the currency objective as keeping the inflation in consumer prices low and stable. The RBA aims to keep inflation in these prices low and stable by using its flexible inflation target, where it sets monetary policy to keep inflation between 2 to 3% per year on average over time. The role of the flexible inflation target in monetary policy, as well as the benefits of low and stable inflation, are discussed in depth in the inflation target video of our monetary policy series. The second objective of monetary policy is full employment. This objective strives to ensure that the economy can provide enough jobs for all Australians who wish to work and are available to work. If everyone in the economy who wants a job has one and is working as many hours as they desire, economists say the economy has reached a state of full employment. However, full employment does not necessarily mean that unemployment will be zero. There are some types of unemployment that monetary policy simply cannot influence. For example, this could be unemployment that arises as people move between jobs. For more information on the different types of unemployment, check out our explainer video on the labour market. Full employment is a very important goal of monetary policy because being unemployed can have enormous economic and social implications on people's lives. The increase in unemployment because of the COVID-19 pandemic has reminded us just how important full employment is. Full employment is also linked to the RBA's flexible inflation target because full employment is usually observed alongside low and stable inflation. The third objective of monetary policy is the economic prosperity and welfare of the Australian people. This objective is linked to the previous two. If inflation is low and stable, and everyone who wants to work is doing so, then people are generally better off. But the prosperity and welfare objective is broader than that. It also means that the RBA board can consider other important issues when it sets monetary policy, like financial stability, if these are expected to affect the prosperity and welfare of Australians. So we've discussed how the objectives of monetary policy are linked to each other, but how do they interact? In the Reserve Bank Act, no one objective is taken to be more important than the others. The RBA is tasked with working towards these three goals at the same time. However, sometimes it might be difficult for the RBA to achieve all of these objectives at the same time, at least in the short term. For example, imagine a situation where inflation is too high at the same time that unemployment is too high, such that the economy is below full employment. The RBA board may want to tighten monetary policy to bring inflation down towards target, but this may also unhelpfully contribute to higher unemployment, moving the RBA further away from its full employment objective. How to set monetary policy in this tricky situation? This situation illustrates the importance of the flexibility of the inflation target. A flexible target means that the RBA can trade off achieving one objective for a short time to focus on another. In our example, depending on the circumstances, the RBA could delay bringing down inflation for a time to focus on reducing unemployment if this was appropriate. Or it could set policy to focus more on bringing inflation down, turning its focus afterward to achieving full employment if that was the priority. The flexible target also allows the RBA board to look past the impact of temporary events on the economy that monetary policy cannot influence. For example, inflation could increase temporarily if there was a natural disaster that destroyed crops and increased the prices of some foods. However, the RBA may decide against tighter monetary policy in this instance because the increase in prices is only expected to be temporary. In all of these instances, so long as inflation is consistent with the target on average over time, then the RBA is meeting its objectives in the medium term. A trade-off between objectives could also occur if adjustments to monetary policy are judged to negatively affect the Reserve Bank's broader responsibilities, such as financial stability. Financial stability is critical to achieving a stable economic environment and thus supporting the prosperity and welfare of the Australian people. The global financial crisis demonstrated how important financial stability is to help a country and its people prosper. So that's all for this video. Next in the series on monetary policy, we'll begin to look at the Reserve Bank's monetary policy tools. See you next time.